And we will now welcome two speakers here. We'll have a panel debate. And there will be John Feneck from the John Feneck Consulting Group, based on demand from commodity companies, especially those in the metals and mining sector. Feneck Consulting Group helps small and mid-cap companies to raise awareness of their brand. And John Feneck, also the founder of the Feneck Commodities report. So please enter the stage. And he will be joined by Eric Strand. And as we know from yesterday's presentation, he's the founder and manager of the successful AuAg Fund, specializing in creating value via investment in commodities. And the theme here will be, is patience really a virtue when you invest? I will kick off with a couple of questions, and as in the previous meeting, you are able to raise your hand and ask questions. And this time, don't be shy. Lift your arm, and you will get the opportunity. John and Eric, it's a pleasure to have you here, both on stage.
Thank you.
As I said, patience, is that really a virtue? You invest, you advise, and you both know, let's say, the industry from the investor's side, which I think is interesting because now we have heard a lot from the supplier's side, and those with the feet on the ground don't necessarily know all the comings and goings when it comes to the equity market. So, Eric, how long is your patience with a holding that doesn't develop in the way that you have expected?
Well, actually, we like to invest with a style like we invest forever. So we are rather patient, I would say, and because we believe in the companies. But of course, we have some candidates to put into the portfolio instead of that company, but we have a lot of trust and we have a lot of communication with the companies whenever they have some problems. But we do understand the markets, and it's not very easy for the companies, so we have a lot of respect for that.
And you mentioned yesterday you had 4 criteria, so if you could just remind us on when you look, it's jurisdiction.
It's jurisdiction, it's of course the portfolio, how much gold or silver or lithium or copper they have. And for us also the liquidity of the stocks, because we have to be able to buy, but especially to sell. And then the management is very important for us. And the 5th thing that we didn't mention is the sustainability. And we don't think that the ESG is gone. We think it is very important, and we are mining better than ever. And we will mine, I hope, even better in the future. And it's our job to put some pressure on this. And I think when we have the discussions with the companies about this, they will always get more institutional investors, and if they get more institutional investors into the company, the equity price will go up, and it's good for the company, it's good for us. So we have a good dialogue around ESG as well.
It pays to be good. And John, if I turn to you, and you're in a role with your hat on as a corporate advisor to a small or mid-cap company, what is the, let's say, 3 most important things when a company is going public? What do you want them to understand about the market?
We don't really work with pre-IPO or close to IPO situations. We're going to be investing in companies that have been around for a while, but I think there's just room for improvement in general. You know, I've been a professional musician since I was 13, and I always learn all the time about music. So it's the same with investing. You continually grow and learn. And as a company, I think you just need to be open-minded to that. When I talk to CEOs a lot in this sector, they're like, hey, I need to get all of my money in the ground, and they miss the entire marketing piece completely. And I think there needs to be a balance. And so we try to work with companies in that regard of striking that balance. While the majority of the money should go in the ground, you also have to get your story out there, and it has to be in a certain way, right? I see so many websites with misspelled words, fact sheets that are outdated, putting putting the share structure all the way in the back instead of in the front, where someone like Eric and I want to see that right away. These are just little things that I help with on the deck and the presentation to a high net worth client, because they're seeing this, and if they see these kind of things, they'll get back to me and say, why did you recommend this? Because it looks sloppy, right? And so like these are little things that I think are important. And we're holding a conference next month in Florida in October at the Four Seasons Fort Lauderdale, and I've really tried to bring companies that share this kind of mindset, that they're willing to interact with clients to get to build relationships, because I think that's important. Building the relationships with clients is so important, because you don't want to, as a junior, mid-tier, or producing company, you don't want to rebuild your capital structure, right? That's something that I see happening a lot, where companies are forced to rebuild this through bad decision making, poor luck. I mean, sometimes it is just luck, that you had bad timing, right? You have a great deposit, but the silver price was depressed, and your all-in sustaining cost was 25 an ounce, and silver was under 25 at the time, but now it's at 32, and the timing of things really matter. And so it's not just management's fault. It's a combination of things. So long answer to say that we try to work with people on their messaging, and also to help get their story out there through conferences like this, and through podcast, TV, radio, Kiko, et cetera.
And I noticed there when you're talking about long relations, and then you would say that you have your investments, well, not forever, but forever. That's the assumption here. So that is, it sounds like, let's say, a plan, but it's easier said than done, I take it. Now, how do you approach companies that you like, but maybe you would like them to, let's say, communicate in a better way? Or do you approach them with that?
Well, first of all, I think that is something that a lot of companies are missing, is the communication and the story, and how they do it. But I also see some companies are starting to do it really good. But mining has a rather bad average on communication. Okay. So I think they can win a lot on just getting good at how to communicate. And I think maybe they communicate sometimes too much about the grades and everything, what is in the ground. I mean, it's important, but anyway, in the end, you have to believe the numbers or what you see, and it doesn't really matter, but it's how you tell the story, and I think that's missing, and how you communicate. But I think we also see some good examples, and I think the rest will follow.
And as we do have a mix of, let's say, professionals, institutionals, retails, would you suggest that a mining company will, let's say, cater to different investors, or should it be, let's say, the same format, albeit a good format rather than a sloppy one? Should there be a difference in the communication?
Absolutely. The retail investor is not a geologist. No. We need to understand that. I'm not a geologist, and this is what I do for a living. So when people are talking, they need to understand a little bit more about their audience, I think. And I really appreciate it in events like this when someone's trying to get to know me, because my previous job was doing that. I was working with private equity, hedge funds, big portfolio managers in the US, and I'd have 1 to 5 minutes to get my point across. That's it. And that's one of the things I work with CEOs on, is their messaging. I think Ashley Berry, who's here, a bunch of you guys know, does a great job of that too. She coaches people in this regard. It's important to have your deck, absolutely, but then you have to have a 15-minute or 10-minute pitch, and you have to have your elevator pitch down. And the elevator pitch is what I find most CEOs struggle with. How can you get your message across in 60 to 120 seconds? And that's important.
And if I turn to you then, Eric, I mean, obviously you don't need to indulge all the tools of the trade here and secrets, but I mean, over a year, how many companies do you, let's say, evaluate? And the reason behind that question is how obviously you being a professional, but let's say you evaluate a number of companies, you will not, I guess, go into depth until you find it interesting. And in that case, what makes it interesting? That's the genius behind that question, if there is a genius.
Well, actually, I think we have almost a slightly different problem, and that is that we have too few companies.
Okay.
Because we have all these mergers and acquisitions.
Right.
And that's a problem for me because I want the universe to be there. And I think when we screen down the universe, we don't have so much left to choose from. So I actually have the opposite problem. And
Interesting.
I probably will see more mergers and acquisitions, so that problem will get bigger. And I hope we get more new companies getting up, so we have some more to choose from, because that's the problem. So we have the portfolio, then we like to have 5-6 candidates that we would like to put in the portfolio, but we have to see they have to be better than something we already have. Right. So that's how we do it. So we have 25 in the portfolio, 5 candidates, but they have to prove, or we have to think that they are better than one existing.
Yesterday you mentioned one thing, if I'm not recollecting in a wrong way here, that you thought that the majors were perhaps looking at companies that were very close to produce rather than, let's say, juniors that were exploring. And the bottom line is that we need more of the commodities. And in that case, you will have to watch and do a lot of work of companies with a smaller market cap. So how do you square the circle?
Well, I don't see it as a problem. I just see it as a different. It's different this time. 2011, when the gold price was really high, they did a lot of spending, explorations on their own. They don't do that. They buy producing companies. Okay. Mid cap. The mega caps buys the mid cap or large cap even, and that doesn't produce more gold, silver, or copper. Right. So the process that the smaller companies will get the money, it will take some more time this time around, and I think that's different. So it takes more time. They have to need to go through this difficult period they have as explorers or developers. They don't have the money. But when it comes, I think the returns in that market will be explosive.
Yes.
And if we look at the market here, we can clearly see that the juniors have been lagging, obviously, the majors and also the underlying price. What do you think are the main reasons for this? If you could just give us 3 main reasons in a world with 1 million reasons.
Well, pointing out at something that probably everyone in the room is aware of, there's never been a disparity like this in history where the gold price is this high and gold explorers, developers in particular, are this low in price. So that gap is going to narrow. I would argue that the explorers and developers are going to do great things over the next 12 to 24 months, and that everyone sitting in this room should go back to their computer when the market opens up today and buy some gold stocks. Seriously. You also want to be buying some silver stocks as well. Silver, hopefully we can get to. If not, I worked on the silver team at Sprott for 2 years. I have a lot of my number one position is physical silver. And yet every time I was interviewed last year, I said silver will not break 26, and here's why. So I try to be pragmatic with clients and listeners like yourselves, because that's, we just talked about building relationships. I want to build relationships with my clients and with you, and be here for the long haul, as opposed to just be talking $80 to $100 silver like so many people I see online, and we've never hit that price ever in history. So it's not something that's helpful to the client base, right? So I feel like the junior market right now is just completely mispriced. I see some people here in the audience that represent some of these companies. Do you mind if I just mention a few
I don't mind.
names? So Taro, I see you first. Taro Kosonen with NewQuest. They oversee a few different companies in the portfolio. One is one that we invest in called Inflection Resources, which is AUCUF in the States and AUCU in Canada. It's an 11-cent US stock right now. They're in New South Wales, which is a great jurisdiction in Australia. If you take some time to look at their deck and look at the board, it's a deep bench of people, and they have a partnership with Anglo. So at 11 cents, what's the risk? I mean, sure, there's risk in everything, but the company is getting most of their drilling funded by Anglo. So it's like seeing this kind of an opportunity every single day with gold doing this, making higher lows, and the stock is literally trading like this. I mean, at some point that gap narrows, and you want to be buying that now because it could be up 40 to 80%, I think, this year by accident. I mean, going from 11 cents to 18 cents or something is completely within the realm of that chart. So those are the kind of opportunities we look for as value managers.
Do we have any?
May I add
Yeah,
something to that?
absolutely.
I think that's because yesterday I spoke. I would like to see miners become price makers and not price takers, as they are. And actually, also, what I think about the exploration companies, I think actually it's a small mistake that they have so low share prices. Because I understand the idea when you have very low and people buy it up to $1 and the returns look amazing. But I mean, actually, they are getting that a little bit in the scamming. It's and actually our custodian and the banks, they don't want us to trade stocks below $1 because these companies, they are scamming in this area below $1, and then they don't. Even if our company would be good, if it's priced at 20 cents, it's not okay for them because they see it as a risk, even if maybe that company is not a risk. So I would like to see them to get over $1 so I can trade the companies.
That's a great point.
Yeah. So yeah, basically, you guys need to do a reverse split.
Yeah,
I agree. I mean, there is a point when you need to do a split, and there is a point when you need to do a reverse split. Any questions from the? There we have one. So you have the mic now.
Question. 1, 2, 3. Question for John Feneck. John, we probably lived, at least in my lifetime, the worst ever situation for this space over the past almost 10 years. What is your vision? What is your feel? What is your what does your experience dictates going forward? Speaking of patience as a virtue.
Yes, that was a timely statement. So looking at producers like an Agnico right now, AEM, beautiful looking chart, right? I mean, like they're doing everything right. Look at their earnings over the last 3 quarters. They're putting up numbers, and that stock is getting some love. But many of the producers still haven't caught up. It's crazy. When you look at the developers and the explorers, they are usually the next 2 groups to catch fire, and they haven't yet really. So that's what we're saying as value managers is that the opportunity now is insane. Like we rarely used words like insane or anything inflammatory, but right now the disconnect is just huge. In my opinion, the reason this disconnect exists is because the average investor that's in the broad market with their serious money is chasing stuff, right? There's a lot of chasing going on in momentum stocks like NVIDIA, you name your favorite tech stock. Look at the S&P 500. I mean, literally over 35% in the top 10 holdings are tech stocks. It's crazy. We've never seen that kind of an overweight in the S&P ever, ever, ever. The last time this happened was 2008, and look at how that ended for those overweight the S&P, right? So I constantly, in my newsletter, put out to people, hey, if you have serious money, you need to meet with your financial advisor, take some money off the table in the broad market, and deploy it into a sector like this that's completely unloved and misunderstood.
Any reflections there? I mean,
no, it's the perfect description of the market, and we see all these difficulties with this global index buying the same companies more and more, especially the U.S. companies. So I think we will have a short circuit breakdown of the index management one day, and it will be painful for the investors having all their money there.
And for those of you that don't believe Eric and I, just look at the news last month in Japan. Okay. Does anyone remember what happened? Nikkei down 12.4% one day.
One day, yeah.
That is not a small index. Yeah. If that happened in the US, that would be mass hysteria.
Yeah, I think it could be worthwhile highlighting that the professional investor will obviously have a correlation between one sector and another. So you can have a negative correlation between, let's say, metals and minings and tech, which means that if you're overweight tech, you need to be underweight another sector. And obviously that has to change in a way.
Can we talk about that for a sec? Because I think Eric and I can help the audience.
Yeah.
When you look at the S&P, the NASDAQ, the Russell 2000, and the Dow, how many gold and silver stocks do you see in there? It's ridiculously low.
Yeah.
It's under 25, I would say, if you really, I mean, Newmont is the only one that comes to mind in the S&P, NEM. So think about how under-owned our sector is. That's the real opportunity. When you start getting real money coming in on the generalist side into our sector, which I think we're on the precipice of. Look at, do you guys know GDX, the big ETF out there run by Feneck? It's a big ETF in the States that will have some of the larger cap producers in it. Look at the top three holdings. It's Agnico, it's Newmont, two that I mentioned, and Barrick, which is symbol GOLD, right? That represents 1/3 almost of the entire ETF. And these companies in January, April, and July have all put up really good quarters. I mean, very quietly, because the market, you know, the broad market is continuing to do this since March of 2009, right? So it's a huge distraction. I think we need to see a correction in the broad market to really bring in people into our sector on the equity side, to answer your question earlier, and that's around the corner. We have so much going on right now. I mean, you know, being a US citizen, look at what's happened with Trump. 2 different people in the last, 3 months, like, have tried to kill him. I mean, it's like, that in itself is a whole nother discussion, but November 5th is the election, right? There's gonna be a lot of uncertainty coming up between now and the election, in my opinion. And I think people that are just playing with their money like it's a casino are gonna get hurt. And they need to think about, you know, real cash flow that's being generated by the names I just mentioned. Go take a look at the numbers. I mean, the numbers don't lie. There's a lot of opportunity in our sector.
Eric, any comments?
Yeah, I would say it's like another perfect storm here. I mean, with the mining sector having this tough 10 years or whatever, and then you have the equity market, bond market going up so much in value, and when you get that, the flows changing, this big money chasing a small sector, I mean, big things will happen.
Yeah.
Yeah, interesting. So there will be obviously an underlying demand for the commodity, particularly precious metals, and the instrument, the equity, the stock in itself is undervalued due to technical reasons, and perhaps some, let's say, one could sharpen up the communications in a way, and if we add into that a reverse split, then there we have it. Well, thank you, gentlemen. It was an honor and a pleasure. I think we should give them an applause.
Thank you. Thank you.
Thank you so much.
Of course.
Thank you.
Thank you.